Let's talk about taxes and moving to a new state. So when you move to a new state, a lot of stuff is happening. You are moving to a new neighborhood. You have new friends, maybe you have a new job. You have a lot of stuff you have to look up for, like new school for the kids, whatever. But we need to really also talk about taxes. So here's an overview I want you to think about. So if you are considering moving to another state, you might want to consider states that do not have state income tax. So you have Alaska, Florida, Nevada, South Dakota, you have Texas, Washington, state of Washington, and Wyoming. But before you move, you need to learn more about other income tax considerations, such as how your current state of residence will tax your retirement income. This is important, whether you are retiring or whether you're moving because you're changing jobs or because of due to love or whatever. You have to really have a clear idea about the tax implications of the state you're living and the state you're going to. So let's first talk about the states without income taxes. Okay, this is really important. So I already gave you those names. So Alaska. Just want to remind you, those states are Alaska, Nevada, South Dakota, Texas, Tennessee, state of Washington, Wyoming, and Florida. Now, Florida has no personal income tax, but does impose taxes on the value of certain business assets. Okay. One other state, New Hampshire, does not tax W-2 wages, but does tax dividends, interest, and certain business income above certain amounts. So you got to be in a certain category to sort of qualify for that. So consideration 1, states without income taxes. Consideration 2, moving expenses. So if your employer is moving you from state to state and paying for your moving expenses, some of your reimbursed moving expenses could be tax-free, but some might appear on your Form W-2 as part of your taxable income. So this is where the employer is probably thinking that this is actually income to you and not reimbursement. So be aware of that. Consideration 3, renting property in the states you live. So even if you establish permanent residency in the new state, if you rent out your house in your old state, you will most likely have to file an income tax return in your old state to report your income and expenses. And if you rent out your house, you will most likely have to report your rental income and expenses on both your old state and your new state income tax returns, okay? However, your new state will most likely allow you a credit for the taxes you pay to your old state because of the rental property income. So this is one of those things where, you have a tax reciprocity. And even if you have a loss on the rental and might not have to file a return in your old state, consider filing a return anyway so that you can establish with your old state that the rental property produced a taxable loss. This might come in handy if you want to carry that loss over to offset some rental income taxable by your old state in the future. You just never know. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. So we're also talking about taxes and moving to a new state, right? So consideration 1, state with income taxes. Consideration 2, moving expenses. Consideration 3, renting property in the states that you live. Consideration 4, moving to a third state. And this could happen depending on your job or depending on your family situation, whatever, okay? Moving to a third state. So if you move twice during the calendar year and wind up living in 3 states, you might have to pay state income taxes in all 3 states. And so you carefully, you need to read the filing requirements for each state you lived in before you fill out your return. This is kind of important. By the way, if you have any question on this, please let us know in the comment section. Tell us exactly the 3 states or the 4 states in which you have lived throughout the year, and we'll let you know exactly the steps you need to take. Otherwise, you can also just hire a tax attorney or a CPA or an enrolled agent. If your tax situation is a little quote unquote complicated and you would like to have expert guidance, you can certainly reach out to a professional. Okay, so if you move to a third state or even a 4th state for that matter, you want to really take some extra steps. Consideration 5, interest and dividend income from your old state. So what happens here is that interest and dividend income is generally taxable by the state where you are considered a permanent resident. Okay, so if you move from, let's say, Arizona to California and it's a permanent move, California will tax you on the interest income from your Arizona bank account during the time you are a resident of California, and Arizona will not tax you for the same period. Okay. However, if the income you receive is part of a business that you have in the old state, both states will tax the income and you must apply for a credit on your new state's tax return. So let me give you an example. Let's say you receive interest on the accounts receivable in the sole proprietorship you operate in Arizona, and you are a permanent resident of California now. you have to pay tax on the interest on your business accounts receivable to Arizona and apply for a credit on your California taxes. So it's one of those things where you have to remember to actually claim the credit and actually pay taxes twice. Okay, if you don't claim it, then you have to pay taxes twice, but you have to remember so that at the end of the day, you are able to actually pay taxes only once. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about taxes and moving to a new state. Consideration 6. Tax-exempt state investments from your old state. Okay, if you have investments that are exempt for your old state, they may be taxable in your new state. You never know. Like states have different sort of tax laws. Okay, and let me give you an example. Let's say if you live in North Carolina and hold municipal bonds from one of the agencies or municipalities of the state, you won't pay tax on that on that income if you are a permanent resident of North Carolina. But if you own the same bond and live in Idaho, for instance, you pay Idaho income tax on the income. So you want to review your financial portfolio as part of your move preparations. And again, if you need expert help, you can either ask us in the comment section below, or I'll certainly get back to you, or you can just enlist the help of a professional. Okay, it's always important, depending on the complexity of your taxes, to always hire a tax attorney or a CPA or an enrolled agent, somebody who knows what they're doing, so that you are sure that you are filing taxes properly. Okay, because the last thing you want is to have headaches from the IRS, headaches from your state tax authorities, from the old state, but also from the new state. It's just crazy. So you want to make sure that you do things right. So consideration 6, tax-exempt states investments. Consideration 7, tax-exempt federal bonds and other investments. So states do not make you pay income tax on federal obligations such as Series EE bonds or Treasury notes. However, states don't all agree on what exactly a federal obligation is. This is one of those things where you have to really sort of account for the specific states, the rules in the specific states you're in. So some states consider that if an obligation is backed by the federal government, the obligation is tax exempt. Others say that this criterion is not enough, and they will tax certain obligations because the obligations is invested only in something backed by the government, but not in the government. So it's one of those things where you have to, again, depending upon the state you're in, you want to make sure that you are pretty clear. The one thing you can do also is actually call the state tax authorities, call the revenue department in your state, and you can ask questions about this thing, just to make sure that you are on the right side of the law. Very important. Consideration 8. So we have retirement income. So most states that collect income tax also tax your retirement income, although the method they use to determine the retirement tax will vary from state to state. Okay, and it's one of those things again where you have what we call tax peculiarities. I'll get it. Tax peculiarities. And so some states provide a fixed amount that you can subtract from certain retirement income, and others don't tax certain pensions at all. Let me give you an example. Depending on your age, Utah has a set amount that you can deduct from qualified retirement income. Louisiana, on the other hand, doesn't tax pensions received by state and local government employees at all, and provides a break for private pensions too. So again, it's one of those things where there's no such thing as a right state or bad state, whatever. You just have to know the rules of the law in the state you're in. So if you are receiving retirement income from a business in your old state, but you move to a new state, federal law says that your new state can tax your retirement income, but your old state can't. Okay, so it's one of those things where, again, you have what we call state tax peculiarities. So consideration 8, retirement income. Consideration 9, penalties for unpaid estimated taxes. So if you have income that is not subject to state income tax withholding, such as pension or investment income, be sure to check out the estimated tax payment requirements in your new state. So because you don't want to get hit with underpayment penalties at all. Okay, so this is really important. So those are the top 9 considerations you have to really have if you're moving to a new state. Let me just quickly recap them for you. So consideration 1, states without income taxes. Consideration 2, moving expenses. Consideration 3, renting property in the state you live. Consideration 4, moving to a third or a fourth state for that matter. Consideration 5, interest and dividend income from your old state. Consideration 6, you have tax-exempt state investments from your old states. Consideration 7, tax-exempt federal bonds and other investments. Consideration 8, retirement income. Consideration 9, penalties for unpaid estimated taxes. By the way, boss, I want to quickly remind you of today's topic. We're having a conversation about taxes and moving to a new state. Let me give you a few pro tips here. So as we're having a conversation about taxes and moving to a new state here, how do states calculate income tax? So while most states start with your AGI, your adjusted gross income, to determine your taxable income, and again, the AGI, that's the federal AGI, basically your new state may handle other tax-related areas, such as itemized deductions, differently. So consider the following questions when figuring taxes for your new state out. So how does your new state handle itemized deductions? So while most states handle itemized deductions like a federal return, some states allow only a fixed amount of deductions, no matter how many deductions you have on your federal return. So be aware of that. And so the second question you want to really think about is that, does your state allow you to deduct state taxes? And so most states will not allow you to deduct some income taxes you paid, but some states go the opposite route and actually allow you to deduct a portion of the federal income tax you paid. So it's one of those things where you want to be clear. You want to seek clarity in the new states that you're going to ask tax authorities, or if you have a quote-unquote complex tax situation, you want to enlist the help of a tax professional who can really help you out. Okay, and another question you want to contemplate here is, has your state incorporated the latest federal tax changes? So even though most states use the Internal Revenue Code, the IRC that we all use as the starting point to determine state taxable income, many states have been really slow to incorporate the latest federal changes, or have handpicked the portions of the IRC they want to use. So it's one of those things where you have to really just you can have an expert assist you do your taxes from A to Z. You can actually, the good thing is, if you use a tax software, the tax software is updated automatically. So basically what they do is that the algorithm will update new tax legislation at the federal level, but also at the state level. So if you use tax software such as Tax Add, TurboTax, H&R Block, Tax Layer, or anything like a Liberty Tax or Justin Hewitt, you are sure that you are getting the latest and the best updates from the state. So this is pretty cool. Now, let me give you the approach you need to really follow here if you are trying to really understand after moving to a new state, what are the tax implications. So if you move, how do you file taxes in multiple states? So the thing is that if you moved this year, you had to get settled in your community and make it feel like a home for yourself and your family, right? Now, if you moved from one state to another, you had even more to do as you registered to vote in your new state and got a new driver's license. And now it's really tax time. There is more you need to do. Luckily, you have to actually think about things in a certain way. And like I said, if you have a tax software, the software will take care of that for you. Now, let's talk about filing past year resident tax returns. So for the year of your move, you will file a part year resident tax return in each state. But please do not worry, because you won't have to pay double the state tax. Each state taxes the income that was earned in that particular state, but most states don't tax the income earned in the other state. So if that's the case for you, you'll divvy up your income between the two states' tax return. Let me give you an example. Let's say if you moved on June 30th, your income through that day will be reported on the tax return you file for the state you used to live in, and your income after that date will be taxed by your current state of residence. So if you had income from interest or dividends that was paid ratably during the year, you will divide that in accordance with the number of days you spent in each location, 50-50, if continuing with the June 30th example that I just gave you, or if you know how much you earn in each state, for instance, you close the savings account in your old location and open one in your new location, you can report the exact income you earn in each state. So it's all about being granular here. And what we have seen in our research here is that a few states require that you report all your income for the year to that state if you are a resident at the end of the year. So for instance, New York does that pretty well. And so if you have to report some of that income to your old state as well, you may be worried that you are paying double state tax on that income. But it's one of those things where on the tax return for your new state, you can claim a tax credit for the tax paid to your old state on the same income. Okay, so it's one of those things where, again, you have to, if you don't report it, you lose it. So you have to report to actually be able to claim it. So that tax credit that I'm just talking to you about will actually offset the extra tax on the income you had to report to both states. So again, everything I'm telling you here, if you have questions, please let us know in the comment section below, and one of our team members will get back to you. Or again, you can use tax software. The cool thing is that once you use tax software, you're taking care of two things at the same time. You can be sure that you are actually abiding by the rules, by the state tax rules, but you're also abiding by the federal tax rules. So, and we're talking about the latest. So if there are changes during the year, those tax software providers update. They actually include the updates automatically. So this is kind of cool. Let me give you a bonus before we close to this conversation. Let's talk about filing taxes after moving to another state, especially if you are in a specific situation. Let's say you actually got a new job, or you actually got married, or you actually you got divorced or whatever. I mean, if stuff happens in your private life, stuff happens in your professional life, stuff happens in your social life, there are certain things you need to really think about here. So basically, just kind of wrap up to this conversation. You got to really think about which state is considered the source of the income, the specific dates that you actually moved and actually moved in and out, moved out of your old state and moved in your new state, the specific states involved. If you changed the jobs or kept the same one, if there is a state income tax reciprocity agreement between the states involved. So those are things you really need to think about. And you'll likely file a part year resident return in both states, as I just told you a few minutes ago. Okay, so usually you'll have to file a state return in any states where you have earned income from wages or self-employment, or have property that creates income. So this is one of those things where you have to just do your math. And so filing taxes after moving to a neighboring state might include a special situation if you keep your job in your original state. So first, you want to find out if there is a reciprocity agreement between those states. So if let's say you moved to Connecticut, but you still kept your job in Jersey, or you kept your job in New York, then you want to really make sure that there is a reciprocity agreement between New York and Connecticut, for instance, or Jersey for that matter. So usually only your state of residence will tax you if you work in the other states and your wages are your only income from the other state. Okay. And so if you're filing 2 part year resident returns, check the rules for each state on what income to report. So income from interest, dividends, and pensions is usually considered to be from your state of residence. Always. This is important. Let me repeat that. Income from interest, dividends, and pensions is usually considered to be from your state of residence. So what happens here is that when reporting your income, you need to keep in mind a few things. Actually, 2 important things. So some states will have you report your income from all sources, just as a full year resident does. Then after the tax is calculated, this amount will be reduced based on the amount you made as a resident compared to your total income. And other states will have you divide the income between states before calculating the tax. So every state has its own approach, so to speak. Thank you so much for your attention. I really appreciate it. In today's conversation, I was just talking to you about taxes and moving to a new state. So I'll give you the overview, the pro tips, the approach, and the bonus. And I just gave you some of the considerations you need to think about as you are moving to a new state. Thank you so much. God bless you. I'll speak to you another time. Until then, remember, stay marvelous.